Dear doctor and students, hello everyone. Today I'm going to share my research or analysis of Apple's stock price volatility. In the field of finance, stock price fluctuations and market trends have always been core issues. As the most influential technology company in the world, Apple's stock price fluctuations have attracted much attention and are of great significance to investors, creditors, and academia. This study used the French three-factor model and the odd model to analyze the reasons for the volatility of Apple X stock price. The French three-factor model was proposed by Hugues Fomo and Kenya French in 1993. It is a company size effect and book-to-market ratio effect to the traditional capital asset pricing model, which can explain changes in stock returns. However, it has limitations such as market efficiency assumptions. The other model proposed by Breyer and Say in 1995 can capture dynamic relationships in time series data and analyze the long-term and short-term relationships between company stock price and economic variables. However, it requires a large sample size, appropriate log order, and assumes stable variable relationships. The objective of this study is to analyze the factors in the French three-factor model that have a significant impact on the stock price changes of Apple Inc. and to explore their limitations and exploratory power. Analyze the long-term and short-term trends of Apple Inc. stock price volatility through the model and evaluate its exploratory power, integrating theory with practice, providing suggestions for relative personnel, and promoting the development of asset pricing theory. In terms of data selections, this study used the stock price data of Apple Inc. from August 1990 to October 2024 from Investment Network with a total sample of 411 observations. By analyzing the volatility of Apple's stock price, we can deepen our understanding of its development model and promote the development of asset pricing theory.
Now, I want to share insights from our study on Apple stock price volatility using the French three-factor model, a cornerstone in asset pricing research. The FF3F model expands the classic CAPM by incorporating three key factors: market risk premium, company size, and book-to-market value. For Apple, our findings reveal a significant positive link between market excess returns and Apple's stock performances, underscoring its sensitivity to broader market dynamics. However, the size factor is negligible, reflecting Apple's transition from a small cap innovator to a dominant large cap leader. Interestingly, the HML factor shows a negative impact, highlighting Apple's growth-oriented nature and its divergence from traditional value stocks. Diagnostic tests further revealed challenges in applying the FF3F model to Apple. Issues like autocorrelation and model instability suggest that the FF3F model, while insightful, does not fully capture the complexity of Apple stock behavior. This points to the need for integrating additional variables or exploring advanced models to enhance predictive accuracy. In summary, the FF3F model offers a robust foundation for understanding Apple stock dynamics, but requires adaptation to account for the unique challenges posed by rapidly evolving technology companies. Our study bridges theory and practice, aiming to empower investors and scholars with deeper insights into asset pricing. Thank you.
Next, I will briefly introduce the application of the ARDR model in our research. One key advantage of using ARDR is that it can handle both stationary and non-stationary variables, making it very flexible. In our study, we used the ARDR model to analyze Apple's stock price movements and understand the factors influencing these changes. So to start, we tested the variables for stationary and found they met the requirements for using the ARDR model. We then built the ARDR 2100 model to examine the relationship between Apple's excess returns and factors like market excess return, size, and book-to-market ratio. In the short term, market excess returns significantly impact the Apple's returns, while the size factor had a little effect. However, in the long term, market excess returns significantly impact Apple returns, while the size factor had little effect. In the long term, both market excess return and the book-to-market ratio had a strong influence, reflecting Apple's characteristics as a growth-focused company. We also performed diagnostic tests. The results showed no significant autocorrelation or heterozygosity, indicating the model worked well for short-term analysis. However, residues were not wrongly distributed, and the criticism of stress tests revealed instability during recent periods, likely due to market disruptions such as COVID-19 pandemic. So in conclusion, our research leveraged the Farmer-French factor and the ARDR model to analyze Apple Inc. stock price behavior from 1990 to 2024. The Farmer-French factor model highlights the significant roles of market risk and growth-oriented factors in Apple's stock returns, but revealed limitations in explaining its complexity, such as autocorrelation and low R-square values. The ARDR model adds depth by capturing both short and long-term dynamics, confirming a strong correlation among factors. While both models offer valuable insights, challenges like non-normality, heterozygosity, and instability in recent years suggest the need for refinement. This study underscores the importance of combining theoretical models with practical adjustments to better analyze the evolving dynamics of technical gains like Apple. So that's all. Thank you for listening.